So, um, is the stock we're looking at today like a hidden, undervalued gem, just primed for a massive short squeeze? Or is it the ultimate value trap catching retail traders completely off guard?
I mean, that is the high-stakes billion-dollar question right there.
Yeah.
Or, given the financials we're about to look at, maybe the $0 question,
Yeah.
honestly.
But hey, before we jump into this absolute roller coaster of a chart, I need to ask you, yes, you listening right now, to like this video and subscribe to our YouTube channel.
And leave a comment, right?
Oh yeah, making it mandatory today. You literally have to leave your feedback in the comments. We're looking at a deeply polarizing setup today, and we want to know exactly what you think about it.
And just to set the ground rules before we look at a single data point, everything we're discussing today is purely an analysis of the provided data, the historical metrics, the technicals.
Right.
We are strictly analyzing the numbers as they exist on the page. We are
Mhm.
absolutely not giving you financial advice.
Yeah, thank you for that. And please keep that disclaimer in mind, because things are about to get wild.
Yeah.
Our mission today is a complete deep dive into SMX, or Security Matters PLC.
Right.
We're analyzing a stack of current data and technicals as of mid-April 2026. And to really understand the massive debate raging around SMX right now, you first have to understand it's incredibly distorted price history.
Oh, the sticker shock on this one is real.
Yeah, let's talk about that. On April 17th, 2026, SMX closed at $4.96. That was after dropping almost 10% in a single day.
Which is, I mean, it's just a drop in the bucket of a much larger, very severe long-term downtrend.
Severe is putting it lightly. It's down 53.82% in just the last month.
Mm-hmm.
And over the past year, it's down 99.98%.
It's basically entirely wiped out.
Exactly. But here is the number that makes algorithmic screeners just completely short-circuit. The recent 52-week low was $4.56. But the 52-week high, it's listed at $30,548.63.
Yeah, which looks like a massive typo, right?
Seriously. So we know that it's a mechanical distortion caused by reverse stock splits. But I want to talk about how this actually weaponizes the chart against retail traders.
Well, it creates this massive psychological trap. You have to think about how charting software handles corporate actions.
Right.
When a company executes a reverse split, say exchanging 10 old shares for one new share to boost the stock price and maintain exchange compliance, your slice of the company remains the exact same size.
They just slice the pie into fewer, larger pieces.
Exactly. But the charting software mathematically adjusts all the past prices to reflect these new consolidated shares.
Right. So retrospectively, it looks like the stock was trading at the price of a mid-sized sedan just a year ago.
Yeah, and it creates this extreme visual anchor. A retail trader looking for a bounce scans the chart, sees a past high of $30,000, sees the current price of $5, and their brain automatically assumes they're looking at the discount of a lifetime.
They assume it's a massive discount because
Yeah.
they aren't factoring in the secondary mechanism that usually accompanies these reverse splits.
The relentless dilution.
Yes. And this is where the math really turns against the shareholder. Let's talk through the mechanics of that dilution with a quick analogy.
Sure.
It's like you traded your 10 dimes for a $1 bill to stay compliant with the exchange.
Right, so you still have a dollar's worth of value.
Exactly. But because the company desperately needs cash to survive, they immediately start printing millions of new dollar bills and selling them to the open market.
Right.
Suddenly, your $1 bill represents a much smaller fraction of the company's total value.
Mm.
The equity gets crushed, the price falls back down, and that dollar just mysteriously shrinks back down into a single dime.
And then the company faces delisting again, right? They execute another reverse split, and the cycle just repeats.
It's brutal.
That is exactly how you generate a chart with a mathematical $30,000 peak that never actually existed in the real world.
Wow. So if that $30,000 peak is just a mathematical illusion, the real question isn't, how do we get back there?
Oh, not at all.
The question is, what is keeping the stock price anchored at $5 today?
Mm.
And to figure that out, we have to look under the hood at the underlying business.
Yeah, let's look at the financials.
Because surely a publicly traded company on a major exchange has something keeping the lights on. Let's look at the fiscal year 2025 and trailing 12 months numbers.
The financials tell a very stark story about why that dilution cycle we just talked about is happening.
Okay, looking at their income statement, the total revenue is exactly $0.00.
Yep. Pre-revenue.
Pre-revenue. Yet somehow, Their operating income is negative $138.69 million, and net income is negative $169.18 million.
It's staggering.
I mean, I realize it costs money to develop technology and maintain a listing, but burning through almost $140 million in operations without a single dollar coming through the front door.
Wait, where's that capital actually going?
Well, when you're a pre-revenue technology firm attempting to pioneer blockchain supply chain tracking, your overhead is massive.
Right.
You're paying for high-level R&D, specialized engineering talent, pilot programs that, they don't yield immediate financial returns.
Yeah, that makes sense.
Plus executive compensation and the heavy legal and administrative burden of just being a publicly traded entity.
Yeah.
But the real shocker is how this translates to the individual shareholder. Have you looked at their earnings per share?
Oh, I have. And the trailing 12 months EPS is negative $623,506.20.
It's almost comical. Which, again, is a denominator effect, right?
Mm-hmm.
The denominator, the number of shares, got tiny due to the reverse splits, while the numerator, the massive financial losses, stayed huge.
Exactly. It concentrates the destruction of capital onto a very small pool of shares.
And the most revealing metric of all is their cash flow, specifically when you map it against their balance sheet. Looking at their balance sheet, they only have $12.2 million in cash left.
Right.
Total assets are sitting at $41.4 million against $22.11 million in liabilities. But their operating cash flow shows they burned $17 million last year.
So they don't even have 12 months of runway left. Not unless they find a way to generate cash immediately. Their day-to-day existence is just a furnace.
So how are they even surviving?
You have to look at the financing cash flow, which was positive $29.75 million.
Wow. Okay, so they burned $17 million operating the business, but they brought in almost $30 million through financing.
Right. And that brings us right back to the dilution mechanism we just outlined earlier.
They're organically burning cash, and the only way to pay the bills is to sell more equity or issue convertible debt.
Exactly. They are surviving solely by diluting the people who already own the stock.
That's awful.
It is a structural issue. When a company relies on financing cash flow to offset zero operating cash flow, every rally in the stock price becomes an opportunity for the company to issue shares and raise capital.
Oh, I see. So it acts as an artificial ceiling on the stock.
Precisely.
That totally makes sense.
Right.
I was looking at the technicals, specifically the beta, which sits at an astronomical 21.01.
Yeah, that's incredibly high.
That tells me this stock doesn't care what the broader economy or the S&P 500 is doing today. It's trading purely on isolated, violent speculation. Is that why traditional support levels are failing here?
Without a doubt, a beta of 21 means that normal predictive models become highly unreliable. The stock is essentially completely decoupled from broader market mechanics.
It's just doing its own chaotic thing.
Exactly. It trades on hyper-specific bursts of algorithmic order flow and momentum. When you have an asset this volatile, the bid-ask spreads widen and the price action becomes incredibly erratic.
And the momentum indicators are showing us exactly how erratic it is. The RSI is at 39.59.
Which is approaching oversold territory, but it remains firmly bearish.
Right. But the indicator that really stands out to me is the MAD, which is at negative 0.165.
Yeah, that's a very strong negative sell signal.
Essentially, this indicator looks at the relationship between two moving averages. And right now, the short-term momentum is accelerating downward way faster than the long-term trend. It's not just dropping. The drop is picking up speed.
Which explains the moving averages. The price is at $4.96, but the 50-day simple moving average is all the way up at $25.77.
Wow.
And the 200-day simple moving average is at $1,161.65.
So the stock is just trapped in a technical basement.
Pretty much.
Yeah.
And if you look at the order flow, heavy selling pressure is dominating. Immediate support is clinging by its fingernails to that recent 52-week low of $4.56.
While the resistance ceilings it would have to break through to gain any actual upward momentum are stacked heavily against it. You've got immediate resistance at $5.64.
Right.
Then $8.17 and a massive wall at $14.33.
With momentum accelerating downward and heavy resistance overhead, the technical story is honestly just as grim as the fundamental story.
Okay, wait, let me push back on the consensus that this is just a guarantee trap.
Sure.
We're pointing out the zero revenue and the brutal technicals, but they do have actual, tangible blockchain technology. They aren't just a shell company.
That's true. They do have real tech.
Right. They recently partnered with M2i Global to track strategic minerals,
Mhm.
and the major catalyst was just a couple of weeks ago. On April 6th, they launched the Digital Material Passport platform, or DMPP.
Yep, the DMPP.
What does that actually do, and why does the market care?
Well, the DMPP is basically a digital twin for physical materials. The idea is to use blockchain to create an immutable ledger tracking the origin, the ESG compliance, and the life cycle of materials, particularly strategic minerals like rare earth metals.
Okay.
And in a world where governments and defense contractors are heavily focused on ensuring their supply chains don't rely on sanctioned entities or conflict zones, a proven blockchain tracking platform is highly lucrative.
So if they land one massive government or defense contract for tracking those strategic minerals, doesn't that fundamentally change the narrative overnight?
It absolutely could.
The bull case relies entirely on the structural mechanics of the stock combined with that catalyst.
Yeah.
Let's look at the float. The number of shares actually available for public trading is under 300,000 shares. That is incredibly small.
It is microscopically small for a publicly traded company.
And here is the kicker.
Yeah.
According to retail trackers, the short interest is estimated to be as high as 300%.
Which is just wild to think about.
Yeah. With short interest estimated at 300% on a float of under 300,000 shares, we aren't just looking at a heavily shorted stock.
No, we're looking at a mathematical anomaly.
Exactly. The same shares are being lent out and shorted multiple times over.
It is the definition of a powder keg. If you have a tiny amount of shares available and a massive number of short sellers who are legally obligated to buy those shares back eventually to cover their positions.
Any major positive news could force them all to buy at the exact same time.
Yes, like a government contract for the DMPP.
Hmm.
On a float of 300,000 shares, the price wouldn't just squeeze, it would go completely parabolic.
And we actually saw a preview of this, didn't we?
Mhm.
That April 6th launch of the Digital Material Passport platform sparked a sudden 53% price spike.
We did.
For a minute, the bulls looked incredibly right. The technology seemed to be validating the risk. But then we have to pivot to the bear case. Because what happened immediately after that 53% spike?
The rally immediately resulted in a pivot top, and the stock crashed 61.85%.
Ouch.
Yeah, it completely wiped out the gains and pushed the price to new lows. This is the exact anatomical structure of a value trap.
Let's break down why that happens. The news drops, algorithmic scanners pick up the volume, retail traders get alerted, and FOMO kicks in.
Yep, fear of missing out.
Right. They buy in, driving the price up 53%. But who is selling to them at the top?
Remember that positive $30 million in financing cash flow we talked about?
Oh, right. The dilution.
Exactly. When a company relies on convertible notes or equity issuance to survive, the institutions holding those notes use these liquidity events, these massive 53% spikes, to convert their debt into shares and sell them into the open market. Or the company itself issues new shares directly into the rally. The retail traders buying the breakout are really just providing exit liquidity for the institutional holders.
So the retail traders see the words low float, blockchain, and digital material passport, and they think they're buying the bottom of a massive tech reversal.
Right.
But they're really just buying into an ongoing capital generation scheme for a company that has no other way to pay its bills.
This raises an incredibly important point about the psychology of treating volatile assets. Traders look at the 300% short interest and the microscopic float, and they try to time a mechanical market event, the short squeeze.
Yeah.
They're ignoring the fundamental reality of zero revenue because they believe the mechanics will overpower the fundamentals.
They are betting that the powder keg explodes before the cash furnace runs out of fuel.
Exactly.
Which leads us to the final piece of our deep dive.
Yeah.
The ratings, the risks, and the actual outlook moving forward.
Yeah.
Weighing the very real potential of that blockchain platform against the harsh reality of their balance sheet, what are the professionals actually saying?
If you look at institutional analysts, they maintain a consensus strong sell rating across the board.
Strong sell. Wow.
Yeah. They're looking at the technicals, the RSI, the MACD, the negative cash flow, and they're projecting continued weakness in the short term. They see a company that does not have the runway to commercialize its product without massive further dilution.
And in the medium to long term, the downside risks are extreme.
Right.
because we have to talk about the looming Nasdaq delisting threat.
We do. Exchanges like the Nasdaq have minimum bid price requirements, typically around $1. If a stock falls below that and stays there, it gets delisted and moved to the over-the-counter markets.
And the OTC markets are a whole different beast.
Absolutely. They have vastly lower liquidity, less institutional participation, and it becomes incredibly difficult for the company to raise the capital it desperately needs.
So to prevent that, SMX will likely have to rely on yet another reverse split to artificially inflate the price back above the Nasdaq minimums.
Exactly.
So we're looking at this severe dichotomy. On one side, institutional data sees a failing business model that burns cash and actively dilutes its own shareholders just to keep the lights on.
They see the 53% spikes not as a trend reversal, but as an opportunity to short the inevitable dilution.
Right. On the other side, retail speculation sees a lottery ticket with a tiny float, unprecedented short interest, and legitimate blockchain technology that could honestly redefine supply chain tracking if it actually gets adopted.
It is a fascinating battleground between market mechanics and business fundamentals, and it really highlights why understanding the causality behind the numbers is so important.
Yeah, you have to be able to look at a chart, see a $30,000 historical high, and understand the corporate actions that created it, rather than just seeing a massive discount.
Right. You have to know the context.
Okay, let's bring this all together.
Yeah.
SMX is basically walking a tightrope over a very, very deep canyon. On the one hand, if that 300% short interest is accurate on a float of under 300,000 shares, the math for a squeeze is undeniable.
Oh, excellent.
One major contract for their Digital Material Passport platform, and the bears could get wiped out in a matter of hours. But on the other hand, you have a company that has managed to lose almost $140 million in operations in a single year without generating a single cent of revenue.
Their runway is vanishing.
Exactly. The data suggests they are running out of time to prove the commercial viability of their technology before the market mechanics break them completely.
Which leaves us with one final, very provocative thought to end on.
Let's hear it.
With a float this tiny short interest this high and fundamental financials this incredibly weak, what gives first?
Yeah.
Does the blockchain tech finally generate a single dollar of actual revenue, allowing the company to stand on its own 2 feet and trap the short sellers? Or does the Nasdaq finally pull the plug, forcing yet another reverse split to keep that shrinking dollar bill alive, continuing the cycle of capital destruction?
Man, the clock is definitely ticking, and the order flow over the next few weeks will likely tell us the answer.
It absolutely will.
And that is exactly what we want to hear from you about. Drop down into the comments right now and give us your take on this setup. Is SMX a hidden gem waiting for a catalyst? Or is it a textbook value trap? Don't forget to like this video and subscribe to the channel for more deep dives into the data that actually matters.
Thanks for joining us on this one.
And we'll see you next time.